Okay, so we are ready to start. We have another keynote lecture for our conference in Rome, and we have the pleasure to have with us Professor Jeffrey Fred from the Harvard Law School. Before going to Harvard, he used to work in Berkeley. He's one of the top authors that you can find in the field, and we are really proud to have such type of keynote speaker for our event. The focus will be measuring capital flows and why it matters for public policy and for finance. Thanks, Jess.
Thank you, John Dukas, for inviting me to give this talk, and to Gianluca and Roberto for their hospitality, and to all of you for showing up instead of running off to beautiful Rome. So this talk is about capital flows and measuring them correctly, and I'm going to talk about how politicians and regulators in the United States and the EU have gotten very confused about how capital moves between companies and shareholders, and to some extent this confusion is shared by economists, and I'll talk about that at the end. So almost all credit for this work goes to my handsome co-author at Harvard Business School, Charlie Wang, who unfortunately couldn't be here to answer the hard questions that I'm not going to be able to answer. We've published a bunch of papers, including in European Financial Management, on this general topic of measuring capital flows between shareholders and public companies. And we started on this project because of some efforts in the United States, which I'll talk about shortly, to regulate share repurchases. So the outline for my talk is, first I'm going to talk about capital flow confusion in the United States. Then I'm going to talk about capital flow confusion in the EU. And then I'm going to spend a little bit of time talking about capital flows and finance for your academic amusement. Okay, so let's start with the United States. It's a picture of Capitol Hill. These are Congress people being sworn in. Not necessarily the most erudite bunch, and particularly around capital flows, they've gotten themselves very confused. So let me give you some background as to how capital flows became relevant in the United States and also in the EU. Basically, for the last 10 years, there's been a debate in public policy circles and in the academic literature about whether short-termism in public companies is a problem. And you can find a bunch of people at various law schools in the United States saying that short-termism is a problem. It's pejoratively, capitalism is pejoratively denoted as quarterly capitalism. Companies are just focused on trying to get good short-term results at the expense of long-term value for their shareholders and for the economy as a whole. There are people that push that view. There are a bunch of other people who say no. The pressure that's being exerted on public companies in the United States through hedge funds and activists is helpful for reducing agency costs, and concerns over short-termism are greatly exaggerated. I'm more with that camp. So it's hard to figure out whether there is actually short-termism or not when you try to do an academic study. I mean, there's some evidence that stock market pressures can cause executives to do things that are not consistent with long-term value maximization. But the magnitudes are not very large. And the fact that there are hedge funds out there and activists who could show up at any time cause management teams to deploy capital more efficiently, run their businesses better, and that's a benefit that accrues across the entire ecosystem that you can't really manage. So anyways, there's this ongoing academic debate in regulatory circles about whether short-termism is a problem. Since 2015, a new element has entered this debate, and that is the magnitude of shareholder payouts. So people are saying that, well, companies in the United States are distributing large amounts of dividends and cash through buybacks, and that's evidence of pervasive and harmful market-induced short-termism. And the idea is that too much cash is leaving companies to allow the companies to pay adequate wages and to make necessary investments for their long-term future. Now, this argument, or this element in the debate over short-termism, can be traced to a single person, basically. And his name is William Lazonick. Now, William Lazonick used to teach in the Harvard Economics Department. He was a Marxist economist. He did not get tenure. He ended up going to University of Massachusetts Lowell. And he's basically been railing against the American capitalist system ever since, for like decades. And in 2014, he published an article in the Harvard Business Review called Profits Without Prosperity. And this is how it's described by the Harvard Business Review. A meticulously researched study by William Lazonick, a professor at the University of Massachusetts Lowell, suggests that executives are using massive stock buybacks to manipulate share prices and boost their own pay at great cost to innovation and employment. And in the highlighted section there, you can sort of see the core of the argument. The allocation of corporate profits to stock buybacks deserves much of the blame for the failure of corporate profitability to translate into economic prosperity. He looks at a bunch of companies and he says, during that period, these companies used 54% of their net income, a total of $2.4 trillion, to buy back their own stock, almost all through purchases on the open market. Dividends absorbed an additional 37% of their net income. That left very little for investments in productive capabilities or higher incomes for employees. And this article was accepted by the Harvard Business Review, which doesn't accept many articles. And it also won a McKinsey Award for like the best article of that year, which, as we will see, does not say great things about McKinsey's judgment. Okay, so Lazonick publishes this article, and he's like a prophet or a Svengali. It was just extremely influential because he's basically like running around and telling people that America has a lot of problems, and the source of all these problems is buybacks. And if only we can stop buybacks, we can save America. And if you're like a young Democratic staffer in Washington who's looking for something for your senator or congressman to do, right? Somebody comes in, he's smart, charismatic, he's got data, he published in the Harvard Business Review, and he says all you have to do is just stop stock buybacks and we'll save America. So it was very appealing to people, and you see like the Brookings Institution, which is a moderate to left think tank, adopting this view that shareholder payouts are too large. The Roosevelt Institute, which is a relatively new left-wing think tank, gets all over repurchases and has been writing about them ever since. BlackRock's Larry Fink, a billionaire who understands Wall Street, he starts writing in his annual letter, companies are distributing too much cash to shareholders, and he basically takes like the Lazonick figures. Corporate lawyers who defend boards, of course, they're going to love this because they want to do anything they can to disempower activists who threaten the directors that hire them. So Marty Lipton of the famous law firm Wachtell Lipton gets on board. it spreads like wildfire among Democratic policymakers. So Biden in 2016, after he decides not to run for the presidency, he writes something in the Wall Street Journal, taking Lazonick's figures. Clinton, in her campaign, talks about excessive buybacks. A bunch of senators, Baldwin, Schumer, Elizabeth Warren, who used to be my colleague at Harvard Law School, gets all over buybacks. We lost one of Republican to this craziness, Marco Rubio, who in 2019 starts writing about how buybacks are destroying America. And even some prominent economists start focusing on these payouts as some symptom of some issue in corporate governance. Okay, so Charlie and I crunched the numbers, and we confirmed that what Lazonick was saying was correct in terms of the magnitudes that he was reporting. So this is from 2007 to 2016. The gray in the background is total net income for the S&P 500. The solid blue line is total shareholder payouts. The dashed green line is repurchases. There were $7 trillion in shareholder payouts, $4.2 trillion in buybacks, $2.8 trillion in dividends, 96% of total net income. Okay, so we crunched the numbers. Basically, what he's reporting is correct in terms of the numbers. By now, there's like massive hysteria in Washington. There are Senate bills that are proposed to give the SEC, the Securities and Exchange Commission, the authority to reject buybacks that, in the SEC's judgment, hurt workers. And Elizabeth Warren and Tammy Baldwin also introduced a bill that will ban open market repurchases. Kill open market repurchases, save the world. Okay, so are the claims valid? Do buybacks starve companies of the capital necessary for investment? Is there evidence of pervasive and harmful short-termism in the US market? So the problem with Lazonick's analysis, which has gotten everybody all excited, is that he's ignoring equity issuances. So buybacks and repurchases move cash from companies to shareholders, but there's a lot of value moving from shareholders to companies in the form of equity issuances. And many of the shares that are repurchased to be given to employees and they're later reissued. If you look at share counts over time in US public companies, they tend to remain stable or increase over time. Anybody can just sort of look at the share count and see that this is happening if they're interested in getting to the truth. Okay, so let's talk about equity issuances. This is something that's a little subtle, but I think important and useful for understanding what's actually happening in public companies in the US and the EU, but also it's something that economists should keep in mind when they're thinking about doing work on capital flows. So there are really two types of equity issuances to shareholders. There are direct equity issuances, which are sales by the company of stock with cash coming into the company. And those are easy to see in the financials of the company. They can take various forms. You could have a seasoned equity offering, which could either be a firm commitment or at the market. Now, most of the seasoned equity offerings in the US are at the market. They're just basically sold in the open market by companies. You could have a private placement, a rights offering, dividend reinvestment plan. Those are examples of direct equity issuances, and they're very easy to understand and very easy to track. More important are indirect equity issuances to shareholders. About 50% of equity issuances are used to pay employees, and about 20% are used to buy assets from other companies or stock in other companies. But from the point of view of capital flows and how much money is actually flowing to shareholders, all of these types of issuances are identical, as I'm going to explain. So let's start with a simple cash-raising issuance. We have a company called ABC, and it has some current shareholders, and it decides to issue new shares through a seasoned equity offering, and it does that in a transaction where it gets cash from the buyers of the new ABC shares, who could be the current ABC shareholders or new shareholders coming into the public markets. This is the reverse of a stock buyback. Now let's talk about an employee paying issuance. So in an actual transaction, we still have ABC. ABC gives shares to an employee. Now there's going to be some vesting period, but the employee eventually sells the shares into the market, getting cash. So you have buyers of new ABC shares who are not the employee, who are giving cash to the employee in exchange for shares. That is economically equivalent to the transaction on the right, where ABC issues new shares directly to investors, gets cash, and gives cash to the employee. It's exactly the same. I mean, formally it's different, but economically it's exactly the same thing. The employee gets cash, and buyers of new ABC shares give up cash and get more shares. Same thing happens with an acquisition financing issuance. So ABC will issue new shares to shareholders of a target and get stock in the company that they own, or will buy the assets of the company, and then the stock will be distributed to the target shareholders. The target shareholders then sell their shares at some point to buyers of ABC shares in exchange for cash. That's equivalent to a simple equity issuance where ABC gets cash by issuing stock and then gives the cash to the target shareholders. So indirect issuances, at the end of the day, have the same impact on all the parties involved as a direct equity issuance. So if you want to measure payouts to public investors, what you really care about is net shareholder payouts. Net shareholder payouts would be dividends plus repurchases, that's cash going out, minus equity issuances, which can be simplified to dividends minus net equity issuances. And dividends you can get from the CRISP database. Net equity issuances, you measure those by the monthly change in share count times the average monthly stock price. And you can then back out equity issuances or gross equity issuances by taking net equity issuances and adding back repurchases. Okay, so this chart shows the magnitude of equity issuances. That's the orange dashed line. So the solid blue line is repurchases, and the dashed green line is dividends. You can see that just eyeballing it, equity issuances are greater than dividends and not so far from repurchases. In fact, over this period, equity issuances totaled 80% of repurchases, or $3.35 trillion. So a lot of capital is directly or indirectly moving back from shareholders to companies. So this chart shows shareholder payouts and net shareholder payouts during the period 2007 to 2016. The solid green series is shareholder payouts. The dashed orange series is net shareholder payouts. And you can see that if you're looking at net shareholder payouts, it's about half of shareholder payouts. And in one of the years here, it was actually negative. That's the financial crisis with financial firms in the United States issuing a lot of equity. Now, we were just looking at figures for the S&P 500, which is what Lazonick focused on in his paper. But what about non-S&P 500 firms? So S&P 500 firms tend to be older and larger. They're more mature. They're in a phase of their lives where they're returning capital to investors. If you want to look at sort of capital flows in the public firm economy, you've got to look at all the companies and not just the ones that are most likely to be distributing cash. So if you look at non-S&P 500 firms, you see that they have shareholder payouts that are positive, which they have to be. They have to either be zero or positive. Dividends supposed to be purchases. But if you look at net shareholder payouts, this orange series here, they're negative in every year. So basically, if you look at smaller companies, they're on net absorbing capital from public investors every year. So what you want to do is if you want to understand what's happening in public markets, you take the S&P 500 and then you add the other ones, blend it together, and this is what the figure looks like. So cumulative net shareholder payouts are 3.33 trillion. It's about 33% of cumulative public firm shareholder payouts. So it's substantially less because you're now accounting for all the capital that's moving directly or indirectly from shareholders back to public companies. Okay. So if you look at investment during this period, investment in gross terms is going up because the market's expanding. These companies are getting bigger. But if you look at investment intensity, which is various measures of investment over revenues, like the propensity to invest, it's either stable during this period, or if you just look at R&D, it's going up. So you don't see a collapse of investment in U.S. public companies. In fact, R&D over revenue, so that measure of investment intensity, which is the dashed line, is going up during this period substantially. CapEx plus R&D over revenue takes a big dip after the dot-com crash, but eventually claws its way back up. Okay. Well, you could say, well, maybe companies would invest more if they had more cash. But as you can see from this figure, public companies' cash and short-term investments were climbing during this period, and cash and short-term investments as a percentage of total investments were also basically going up. So it's not like these companies are running out of cash. They're sitting on huge amounts of cash. So let's go back to the buyback alarmist claims. So if buybacks are destroying American companies, we should observe the collapse of the level of corporate investments. We don't see that. We should see a decline in corporate investment intensity. We don't see that. We should see companies running out of cash. We don't see that. But there's more. First, the whole point of being a public company is that you can always issue more stock. That's the beauty of being a public company. You can always raise cash. So if these companies did not have enough cash, they could just issue more equity. So so whatever has happened historically is not really a constraint on their ability to engage in investment in the future. The other thing that Lazonick and these other people don't seem to grasp is that when capital flows out of the public company sector, it goes generally into the private company sector. Everybody's focused on public companies because they're big, there's reporting on them, financial reporting, lots of public reporting. They tend to be companies that we have some sort of interaction with, so we're familiar with. But in America, which has like the most developed public company markets in the world, about half of the economy is driven by companies that are not listed. So like half the profits, half the employees, half the investment is driven by companies that are not yet public or may never be public. When capital flows from very mature public companies, it winds up in the hands of private equity investors, venture capital investors, other types of investors, and it gets channeled into private companies. Okay, so so Lazonick had this quote that I highlighted. Companies use 54% of their net income to buy back their own stock, blah, blah, blah. That left very little for investments in productive capabilities or higher incomes for employees. Most repurchased shares are issued to employees who then get cash for them. The analysis ignores equity issuances, which is basically like academic malpractice. And the fact that money is flowing out of the public company sector and going into the private company sector. And you can see by looking at sort of levels of investment, cash levels, there's absolutely no problem. Okay, now we're going to switch to the EU. So capital flow confusion comes to the EU. And it's thanks to our friend, Bill Lazonick, and I'll explain why in a second. So in 2020, the European Commission decided it would be a good idea to come up with new rules to make European public firms more sustainable. Actually, I just don't like that term, sustainable, because we want human existence to be sustainable, but we don't necessarily want firms to be sustainable. Once they've exhausted their purpose, we want them to be shut down and the assets and people to be redeployed to better ventures. Like, we don't want infinitely lived firms. Anyways, that's just my pet peeve. So the European Commission, for some reason that's not fully clear to me or anybody I've spoken to, they adopted as a draft a study that they commissioned Ernst & Young to write on sustainable corporate governance. And apparently it was like a unit of Ernst & Young in Rome. And it was written by some people working for Ernst & Young. And these people were either disciples of Lazonick, or they just were so taken by his work or other people that follow Lazonick that they bought it all. They define short-termism in a particular way, and then they purport to find it in EU firms. And the finding, as we'll talk about, or their claimed finding, is excessive buybacks and falling investment. And they suggest various cures, including like radically altering directors' fiduciary duties. I mean, if the European Commission comes up with a proposal, I guess it's very unlikely that the proposal is going to be we should cut back on regulation, we should allow for more of a free market. It's going to be like more regulatory. So the main finding of the EY report, which was adopted by the European Commission, is that companies focus on short-term benefits of shareholders rather than on the long-term interests of the company. Another pet peeve that I have is when people talk about the long-term interests of a company is a piece of paper. It is literally just a set of contracts that connect a bunch of people. It doesn't have its own soul, its own brain, its own heart. It's just a bunch of people. But when you say the long-term interest of the company or the best interest of the company, you can then write into that whatever you want. So that Ernst & Young included in the best interest of the company, like what's good for the planet. So that's how they define it. Okay, so let's look at the evidence for short-termism that the European Commission found. The first is that shareholder payout, dividends, and repurchases are increasing and high. Of course, Ernst & Young, because they were following the Lazonick model, did not think about or did not want to write about equity issuances, which far exceed repurchases. Net shareholder payouts, as we're going to see, are the right model. They say that CapEx and R&D intensity has declined. They used a flawed sample. I don't know if it was deliberately flawed or accidentally flawed that generated this result. In fact, investment intensity has increased. And then they say that shareholder payouts deprive firms of resources for future investment. In fact, cash balances in EU firms were increased. Let me just run through some of the numbers here. So measuring shareholder firm capital flows, following in the footsteps of Lazonick, Ernst & Young looked at gross shareholder payout, ignored equity issuances, but including equity issuances dramatically changes the picture, just like it does in the United States. So this graph shows shareholder payout and net shareholder payout by EU public firm in the period 1992 to 2019, which was the period that the Ernst & Young report looked at. So the gray background is net income, aggregate net income for EU public firms. The green series is shareholder payouts. It was about 65% of net income during 2010 to 2019, which was the most recent decade. If you look at net shareholder payments, it was about 38% of net income. So after you take into account equity issuances, it's slightly more than half, which is very similar, interestingly, to the level in the United States. Measuring investment. So Ernst & Young uses a flawed sample to come up with this result that investment intensity has fallen. But if you look at all EU public firms, CapEx and R&D levels increased over this long period, 1992 to 2019, including 2010 to 2019, and combined CapEx and R&D intensity increased over this period. So they just used a flawed sample, either deliberately or accidentally, that got them to their very pessimistic story. And they claim that there's not enough capital in these companies to do these excessive payouts, but cash balances in EU public firms are rising. This figure shows cash balances. The most important series is the dark green series. You can see cash balances increasing at EU public firms, so they have plenty of cash. And again, if they need more cash, they can issue more equity. So what happened here is that the European Commission asked for comments on the draft report, and my colleague Holger Spaumann, who teaches at Harvard Law School, is German. He said, Jesse, why don't you and Charlie do the same type of analysis that you did for the United States, do it for the EU, and give it to the European Commission. So we did that, and that's the piece that ended up getting published in the management. The European Commission got so much pushback from us and other people, including academics in Europe, that we ended up sort of disavowing the Ernst & Young report, which just shows that sometimes people will listen to academics. Okay, I just want to say a few things about capital flows and finance before I finish. The first thing is that even academics don't fully get what's going on with equity issuances, in part because it's hard to figure out what's going on with them by looking at standard databases. You have to sort of do the backwards analysis, looking at share counts to figure out what's going on. So sometimes there's no attention paid to equity issuances whatsoever, and sometimes there's an attempt to measure net equity issuances, but it can be incomplete depending on what the purpose of the analysis is. So there are a bunch of papers that look at cash flows from equity issuances minus cash flows from repurchases. But if you just look at that and you're interested in overall capital movements, you're going to miss indirect equity issuances. There are also some papers that look at changes in treasury stock, but sometimes companies issue new shares, and those are not going to be captured when you're just looking at changes in treasury stock. So you're going to miss some of the indirect issuances. But then there's some papers that do get it right. They use the share count approach, and that's what people should be using if they're interested in trying to figure out how capital is moving between companies and public shareholders. Okay, this is my last slide, and I apologize for being dense. And I'm also going to apologize for being sort of cryptic, because it's a paper that Charlie and I, along with Palma, are working on. We posted it online. And it's connected to capital flows, but it's trying to address a different issue than our other work. So basically, companies issue a lot of dividends, they repurchase a lot of stock, they issue a lot of equity. If you want to know what public shareholders are making in public markets in aggregate, you can't do what most academic work does, which is look at total shareholder return, which looks at stock appreciation and then assumes dividends are reinvested in the stock price. Because while any individual investor can reinvest dividends in the stock of a particular company, they can't all do that, obviously. If I'm reinvesting my dividend in stock of a company, I'm buying a share to divest from the company, or it's associated with them divesting from the company. So we have capital that's being distributed by public companies going into the hands of shareholders that in aggregate cannot be reinvested in these companies. It has to go somewhere else, like into bonds or housing or consumption. So this is one reason why TSR is going to not give you an accurate measure of how much public investors are making in aggregate. The other is buybacks and equity issuances. And there's a lot of evidence that companies engage in market timing, which means that buybacks and issuances are done at prices that are either higher or lower than fundamental value at the time as perceived by people inside the company, which means that long-term investors are systematically benefiting at the expense of people that are trading with them. And so TSR is just capturing what the long-term investors are getting, not the other ones. So we put forward another measure called All Shareholder Return, or ASR, which attempts to capture what public investors are making in aggregate by assuming that the net cash that's coming off these companies gets invested in some alternative asset. And when public companies are in net capital raising mode, then cash is taken from this alternative asset. We're still working on this. We'd be happy to get comments. So this is a sort of a request for any comments that you might have after you take a look at the paper. And that's it for my prepared remarks. Thank you.
Thanks a lot for your presentation. So I agree that blaming the repurchases is a bit little sense, because at the end of the day it might be a consequence and not a cause. But how this links with two topics, I've heard a lot about this. First of all, that firms do not go public anymore.
That what?
Firms do not go public anymore. And as a consequence, what happened is that I've seen a keynote speech on that, and they show that because there is this private capital market now, it is true that the worker payout decreases at the benefit of shareholders. So the effect of work is still there. Maybe it's not short-termism. So, and how this would connect this topic of, you know, the number of public firms decreasing with the share repurchases and net issuances topic. Basically, I think they are connected. And second, you showed this picture on the capital expenditure and RD, but actually if you split those, you will find that you see that they are stable. Yeah, this one, but actually the stability is brought from the RD. So if you split CapEx and RD, you will find the CapEx decrease dramatically, and the reason is that it mostly manufacturing firms are going away, right? There is a service work. So my question is this structural change in the US economy has to do with this repurchases theory? Because at the end of the day, that means that you basically are at the end of the agency story here, right? You don't have anymore this extra cash. So there are many topics related to this, and I was wondering how you relate this research to this other issues. Thanks.
Okay, thank you. I think you should give her the microphone back, because I'm sure I'm not going to remember all your questions. Okay? So you said, the first thing you said, which was not really a question, but it was a comment, is that repurchases are a consequence and not a cause. I just want to push back on that a little bit. I mean, basically, the problem with public companies is that they tend to hoard too much cash. Yeah. And the figures that I showed here, they've actually gotten more extreme, since 2016. They're sitting on trillions and trillions of dollars of cash. So I think that generally cash distributions by companies are too low. Now, there are reasons why managers will prefer, if they are forced to distribute cash, or they feel some incentive to distribute cash, they will prefer a repurchase over a dividend. There are a bunch of reasons, actually. One has to do with the structure of their options. So it's a little bit complicated, but basically a dividend will tend to reduce the value of their options, and a repurchase won't. A repurchase can also be used to temporarily shrink the share count, which can, in some circumstances, boost earnings per share, which can boost bonuses. A share repurchase also, mechanically can increase the stock price by creating demand for the stock. These are things that are not necessarily great for the economy. And I sort of came into this, I'm a law professor. I've been writing for 20 years about repurchases and how they can be manipulated by managers. So I'm not a big fan of repurchases. I'd like to see all the money come out through dividends. But I think that's just a managerial agency cost story, basically. And my interest here is not on how to better regulate repurchases, although I have written about that. It's just looking at the magnitudes of the cash flows. Now, let's see if I remember everything that you said. You said the IPO market has died. Well, the IPO market seemed to be dying before 2020 and 2021, and then it exploded. because valuations were very high and a lot of companies went public. Before 2020, there's a question as to why IPOs slowed down. There are a number of stories. One is that big tech firms are buying young private tech firms before they can grow and become competitors, so they're not going public. There are also changes. There are also changes in the U.S. market microstructure starting about 20 years ago that made it very hard for smaller companies to go public. Like in the 1990s, you had companies going public with a market cap of 200 or 300 million. Then, because of Sarbanes-Oxley and various measures that were taken to deal with Wall Street analysts, it became almost impossible if you had a small company to take it public. You needed to have like a minimum market cap of $1 billion. So I just think that's a very complicated story, and I think it has to do with sort of regulatory changes and maybe some changes in sort of market structure where big tech companies are buying small companies. I don't think it's something that we might be able to deal with through antitrust, but not really a corporate governance story. So I think your next point was about CapEx. Yes, you're right. CapEx has gone down. Now, my brilliant colleague Mark Rowe has written wonderful things on short-termism, and you can see that basically CapEx is declining in all Western economies and in Japan. It has nothing to do with markets, the stock market and activists or whatever. It has to do with, as you said, a shift to a service sector economy. That's what seems to be going on. What's really important for innovation is R&D, and that's going up. So that's not consistent with the Lazonick story. And then I think the last thing you said was about workers not making a lot of money. I don't think there's any connection between repurchases and workers not making a lot of money, except that, if wages are low, you have more cash, and you can distribute more cash. Why are wages low? I think wages are low because of globalization and the fact that, that most jobs can be outsourced overseas, and that basically reduces labor's bargaining power. Now, people in the United States are trying to work on that, but I don't think it's the Lazonick story. It's not like if we kept the cash bottled up in these companies, workers' wages would rise. The people running these companies are not going to pay workers more than what the market demands. If the cash was bottled up in these companies, they would probably just use it for stupid acquisitions and expansion plans that didn't make any sense. So I think I answered all your questions, but...
Yes, no, that was more not that I thought about giving more cash to the employees, but it's the connection with the private market. So in the private market, you also mentioned this, right? That capitals go in the private market now. And in the private market, basically you have lower wages. So there is a connection in this sense, but I would not blame the repurchases directly. That's what I meant, in a sense.
Yeah, you're saying that wages are lower in non-listed companies? Yeah, I think that's probably because there's more slack, managerial slack, and other types of problems in big companies that can pay. If there's actually data that shows that the same person gets more in a public company than in a non-public company, then I think it's probably because of just more slack in public companies. But a lot of these private companies are planning to go public.
Thanks.
Yeah.
Hello, Jesse. Thanks for your nice talk. And defensive buyback, and also trying to convince the European Commission not to adopt the stupid Lazonick ideology. Now, how come it doesn't work in America? How come academics in the U.S. are not capable of bringing rationality to politicians there? How come I'm amazed that the Europeans are rational. I'm just kind of astonished by that. So it's kind of, how is, I
Well,
thought Americans were more reasonable people than Europeans.
I'm not gonna comment on who's more reasonable. Food here is definitely better.
Agreed.
So a lot of the noise in Congress is just bills. And what I've come to, that people write, and what I've come to realize is that it's like, virtue signaling. People file bills that they know have like almost no chance of getting adopted, just to show that they are like, they care about workers, or they buy into this buyback is a terrible argument. So the SEC has just come up with some rules for regulating repurchases that I actually proposed in an academic article like 5 or 6 years ago, which I, of course, think are very sensible. There's no other regulation of repurchases that at this point that has any chance of being adopted except for the SEC's proposed rule. The other thing I want to say is that I was in touch with like Biden's economic advisor before he ran for president, and I was explaining to him like, hey, you got to think about equity issuances, you got to think about equity issuances. And I think I might have made an impact because Biden came up with a tax proposal, which is probably going to go nowhere, that would tax companies on buybacks, but give them a credit for equity issuances. So it may be that when push comes to shove, there's a lot of like screaming and yelling and stupid things being said, but when things actually get, through Congress and signed by the White House, that they're going to be relatively sane. But what's really disturbing to me is not like that politicians get confused. It's like people like Larry Fink and these other people who should know better. It's very disheartening when you have like people saying this stuff. Go ahead.
Yeah, thanks. Also, by the way, you should maybe mention that Ernst & Young today were fined $100 million by the SEC for fraud on exams, on ethics exams. I mean, really, that is kind of consistent with your finding that they were cheating on the data there, right? So there's something wrong with Ernst & Young.
Yeah.
Especially the one in Rome, I guess.
I'm not going to be getting my accounting services from them.
Thanks. I'm glad you raised a very important issue. This is not just the case in the EU, and in the UK we had last week we had 3 days of strikes by the rail union, and the general secretary, a Marxist, basically said that companies have got enough money to do these buybacks and to give dividends to shareholders, but not the inflation in the UK is about 9.1%. So he's asking for demands for the rail workers in line with inflation. What he doesn't talk about is people sitting on their backsides for the last 2 years thanks to COVID and getting furlough money. So it's just, I mean, it's a lot of people who get the dividends are essentially retirees who are dependent on an income stream. And I mean, they just completely forget about this, all these things. So it really annoys me, to be honest with you.
I feel your pain.
I'm really glad you raised this issue.
Yeah, thank you. No, I feel it's, I mean, one of the good things about the United States is that there are still enough people who understand business, that there's, in politics, that there's pushback against a lot of these crazy things. So, I'm thankful for that.
Hi, thanks. Very interesting argument against the idea that buybacks and repurchases are causing any drop in investment. However, there is another argument against repurchases, which is kind of inducing mispricing in the market, kind of following these announcements. And that's probably another externality where shareholders can whether you consider that the price changes following these types of events, and whether this is like kind of fundamentally driven or non-fundamentally driven price reactions towards these. So this is also another form of argument against buybacks. It's like kind of a corporate obsession towards increasing market capitalization which could be done through reducing the number of outstanding shares. But as you say, it's also important to look at the net number of outstanding shares. But that's also another channel through which shareholders can also benefit, isn't it?
Yeah, so as I said in response to an earlier question, buybacks have a lot of problems. They can be used in a manipulative way by executives. And one way that they can be used is, and there's evidence that this has happened in the United States, is that there'll be an announcement of a buyback, which if you're going to do a buyback, under our securities laws, you have to announce it. The board has to approve it and it has to be announced. That will cause the stock price to go up. Why does the stock price go up? For two reasons. Basically, there's a signal that the stock may be undervalued. That's one reason. Even if there isn't such a signal, as I said before, the fundamental problem with public companies is that they hoard too much cash. So if the cash can be unlocked and returned to shareholders, shareholders are better off, because instead of the money earning low returns or negative returns by being wasted inside the company or misdeployed, it goes out to the shareholders so they can decide how to deploy it. So when a company says, hey, we're going to distribute a bunch of cash, stock price goes up. Now, in the US, you can say you're going to do a buyback, but what you'll always say in the announcement is subject to market conditions. And about 20% of buyback announcements are not followed by any actual repurchases over the next couple of years, which raises the question, if you're a manager and you want to get the stock price up so that your bonuses can be in the money, or you're planning to sell some stock and you want to sell it at a higher price, why don't you just announce you're going to do a buyback? Get the price up, a couple percent, and then not do it. And this seems to be happening. So this is a problem. I don't really know of an easy way to deal with that. What I've proposed and what the SEC is, said they're going to implement is a rule that says that the actual buybacks, the actual repurchases by companies have to be disclosed within a day. So we have real-time information. Right now we have these buyback announcements, which is like, we're going to buy back $2 billion worth of stock, but it depends on market conditions. And then you don't know what's happening in the market, because the buybacks are, if they're happening, are secret. So now there's going to be disclosure on the actual buybacks, which may help. But there are various ways they can be manipulated, which don't make me happy. But if John invites me back for another EFMA conference, I'll talk about all the things I don't like about buybacks. Next year, okay. Thank you.